Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. So much to discuss today. We're going to talk about the FOMC meeting, the jobs report, the latest in markets and investing. So stick around to the end. If you're watching this on YouTube, as always, hit that subscribe button for more content just like it. So let's start out with the blowout jobs report. Huge beat in terms of expectations. We're down at 170,000 jobs for January. The number comes in at 353,000, and we also saw upward revisions for the prior months as well. If we look at the number of months now where we've seen positive payrolls, 37 consecutive months, so over 3 years of each and every month, more jobs being added in terms of the U.S. economy. Where are those jobs coming from? If we look at the latest report, healthcare, once again, number one. This was a big theme throughout 2023, continuing so far in 2024. 100,000 jobs added there. As we talked about last year, big shortage in the healthcare sector. This is going to be a secular trend for years to come as we have an aging population. Demand for healthcare workers very, very high. And so this is likely to continue for many years. We also saw professional business services bounce back here, 74,000 jobs added, retail trade, 45,000, and government, which is one of the biggest sectors in 2023, once again adding jobs there, 36,000 for the month of January. And that unemployment rate just doesn't seem to want to move up here. So for second consecutive month, we saw expectations of a tick up. So people in December were saying it's going to go up to 3.8%. It didn't happen. It stayed at 3.7%. And again, this month, expectations were for a rise in the unemployment rate, and that didn't happen. So still at 3.7%, not far above where we were last April, the 3.4% reading, which was the lowest that we've seen in the U.S. since 1969. And speaking of streaks that we haven't seen in a long time, you really have to go back to the late 1960s to see this many months in a row, 24 consecutive months with the unemployment rate below 4%. So 2 years now at that very low level. We haven't seen that since the late 1960s. Biggest surprise, I would say, though, has to be wage growth. 4.1% year over year was the expectation, comes in at 4.5%, so much hotter than expected. You put all this together, what happened to Fed Fund futures? Well, Fed Fund futures said pretty much say goodbye to the March rate cut. And in terms of the FOMC meeting, similar message being delivered there, but we got the employment report after that. That was kind of the nail in the coffin, I would say, for this March rate cut. What did the Fed do? It did exactly what we said they would do. The market was expecting no change. They didn't change rates. They didn't change their balance sheet plan, still reducing their balance sheet. And the important language from the press conference was Powell kind of emphasizing that we want to make sure we get the job done in a sustainable way. So he's saying, he's acknowledging inflation's come down, but they want to make sure they get the job done in a sustainable way. And he said it's not likely that the committee will reach a level of confidence in terms of inflation coming down in a sustainable way by that March meeting. And although he did say it remains to be seen, it seems like when they're ready to do it, they'll probably really telegraph that it's going to happen at the next meeting. So expectations shifted after the FOMC meeting to the month of May, and after the jobs report, they shifted even more. And now we have less than a 20% probability of the Fed cutting rates at the March meeting. It was only a month ago where this probability was north of 70%. So big change in the last month. And as we said, entering the year, this could be one of the big surprises in terms of market participants, expecting a very dovish, very easy Fed, perhaps too much in terms of expectations. Remember, the market was expecting 6 rate cuts this year, while the Fed was only projecting 3. And already here we are, the market is having to push back those expectations in terms of their cut to start in the month of May. If we look at the curve now, I updated this chart here. This is the expectations of the market in terms of the Fed funds rate. And coming into the year, this was below 4%, the year-end expectation, and now we're at 4.1%. So they've kind of taken away one of the rate cuts, and they said now the market's saying now that it's not going to start until the month of May. And in terms of the balance sheet, the Fed didn't give a lot of clues there. A lot of people are saying, well, maybe they're going to start uh, slowing down the pace of quantitative tightening starting in March. Some people say, no, it's not going to happen until May. Other people are saying it's going to continue at the current pace for the rest of the year. So we'll see. They haven't said anything definitively there, but we do know that it's continuing for now at that current pace. And now we're at the lowest levels we've seen since I think March 2021, 1.3 trillion decline. And if we look at the balance sheet here, there's really no reason why the Fed should be stopping this anytime soon, because we're still $3.5 trillion above where we were in February 2020. And that's how much quantitative easing we put into the system, with the Fed buying everything from treasuries to mortgage bonds. And they were even borrowing corporate bonds for the first time ever as well. Well, this tightening so far has only reduced a small portion of that quantitative easing. So really, they should continue this, but we'll see. At some point, they'll likely slow it down before they stop reducing it altogether. So in terms of the Fed, they push back the expectations. Not going to happen likely in March. Remember, the Fed almost always does what the market's expecting it to do. So if those expectations are like we saw on that chart there, and there's a less than 20% chance of a cut, the Fed's not likely to cut. But as we progress throughout the year, I think it's going to be more and more pressure on the Fed to cut rates. We'll talk about inflation in a little bit, but inflation in terms of CPI is likely to come down a lot when we get the next inflation report, and people are going to be saying, why is the Fed staying here? They should be cutting rates. And I think what we're likely to see this year is an opposite of what we saw in 2021 and for most of 2022, which was a global hiking cycle. What we're likely to see this year is a global cutting cycle. And interestingly, the areas of the world that hiked first, so if we look at emerging markets and Latin America, these were the countries that were hiking rates well before the Federal Reserve or the Bank of England or the ECB. Well, they have started to cut last year, and they continue to cut now. If you look at in the last week, Chile, Brazil, and Colombia cut rates again. And I think at some point, many of these other countries are going to join them. So it's just really a question for the US, the Eurozone, the UK, Canada. All of them are talking about cutting rates this year. They're just not yet ready to do so. But most likely, if we fast forward 6 months from now, we're going to have a lot more cuts in this column. And the simple reason for that is inflation has come down to the point where the central bank rate is now in most countries above the rate of inflation. That gives you room to ease. The biggest room, as we've talked about, is in many of these emerging market countries where you have the biggest spread, the highest real interest rates, and they were the first to cut rates. So I think across the board, we're going to see more cuts. Definitely, China seems to be primed for cutting rates again in terms of their economy slowing down significantly. Their stock market, we've talked about. We're going to talk about that also as well. So expectation here is that we're going to see many more cuts this year from central banks around the globe. So let's talk about earnings and the money-making machines and really big tech. Another strong quarter almost across the board. If we look at S&P 500 earnings really being driven by these largest companies. Now we have 46% of companies reported so far. By next week on this update, we'll probably have north of 2/3 companies reported. So we'll have a better idea then. But so far, so good, I would say. 16% year over year GAAP EPS growth for S&P 500 companies. Now that's the fourth straight quarter of positive year-over-year growth for the S&P 500 in terms of earnings. So really solidly out of that earnings recession that we saw in 2022. And let's break down some of the major reports we got this week. Start with Google here. Phenomenal report out of Google. The stock sold off a little bit after earnings, but it had run up significantly heading into it, so I wouldn't read too much into it. 13.5% year-over-year revenue growth. Revenue hit a new quarterly high of $86 billion for Google, and net income was up 52% year-over-year to $21 billion, which was also a record for Google. And here's the important part. expanding not only the top line, but bottom line and profit margins as well. Operating profit margins moving up to 27% from 24% a year ago. So just very, very strong quarter out of Google. Microsoft, similarly, 17.6% revenue growth over the last year. It's a new quarterly high in terms of revenue, 62 billion. Net income grew 33% over the last year to 22 billion, in operating profit margins similar to Google expanded 39% up to 44% today. Meta, huge beat here in terms of the numbers versus expectations across the board. You had a new quarterly high for Meta in terms of revenue at 40 billion, really blowing away expectations there. Net income rose over 200% in the past year to 14 billion. That was also a record. And the dividend, for the first time, they declared a dividend 50 cents per share. Not a huge dividend, 50 cents per share, but market was not expecting that, and they upped their buyback program to 50 billion as well. Stock really rallied on that. It was up over 20% after the earnings report, new all-time high. And just look at the turnaround in terms of Meta from where it was in October 2022. You had a 77% decline in Meta stock from the peak in 2021 to the low in 2022, and now 445% rally, new all-time high off of those October 2022 lows. So what a difference in terms of sentiment. What a turnaround for the company. They cut costs dramatically. They turned the ship around. Top line at new highs, bottom line at new highs. So across the board, a blowout quarter from Meta, and shareholders seem to be very happy. And that's evidenced by the strength in the stock price. So Apple, a little bit different than those other three there in terms of revenue growth, much lower here, 2% year over year. But for Apple, that was the first positive quarter that we saw since Q2 2022. So a little bit of a drought for Apple, had negative year over year revenue growth. The bottom line did much better than the top line, net income growing 13% over the past year to 34 billion. Apple remains the most profitable company in the world, over 100 billion in terms of net income, revenues 386 billion. The difference from Apple from the other Magnificent Seven names is in terms of this top line growth. We just see last few years barely increasing in terms of revenue, net income flat from 2021 to today. So Apple in a different position, I would say, than those other Mag 7 names. It's going to have to find new ways to push revenues higher, put new ways to push net income higher. But certainly the stock has done tremendously well over the past few years, and the stock, not a huge reaction at all to the earnings report. So it seems like the expectations kind of right in line with those expectations. If we look at overall Q4 revenue growth for the major companies in the US, again, pretty strong overall. Meta, 25% year over year growth, Microsoft 18%, Amazon 14%, Google 13%, Netflix at 12%, AMD 10%, the S&P 500 so far overall 5% revenue growth year over year. And then we have Tesla and Apple on the bottom here, up 3% and 2% year over year. And how is the market reacting to earnings so far? I would say just fine. It's hitting all-time highs as we speak, and it's now starting to put some distance over that prior high that we saw from early 2022. Now we're up 1, 2, 3, 4 weeks in a row. So market so far seems to like earnings, seems to like what the Fed is saying, and seems to like the jobs report. There's that old saying that people are starting to talk about again, Goldilocks, and that seems to be the scenario for now. Economy doing well, Fed policy right where people want it to be, with the expectation that there's going to be rate cuts this year. So overall, a lot of optimism, very different than what we were talking about a year ago. So sentiment, total opposite end of the spectrum today. Let's talk about the iron rule of financial markets. This is something that John Bogle from Vanguard used to talk about. And really the iron rule of financial markets is reversion to the mean. That when something becomes very extreme, it tends to revert back to the mean over time. Here I'm showing the example of ARK Innovation ETF versus Berkshire Hathaway. This was in the 3-year period leading up to the peak, what I would call the peak in the mania, which was February 2021. Even though the overall S&P 500 didn't peak until early 2022, the most speculative areas of the market, if we're talking about SPACs or we're talking about meme stocks, peaked right around this time. If we look at the holdings in ARK Innovation, all of these ultra high growth companies, many of them peaked in February 2021. So just enormous outperformance at that point from ARK Innovation versus Berkshire Hathaway, 270% gain over this 3-year period versus Berkshire, up only a little over 5%. Now you fast forward 3 years from this point to today, what do we see? Well, the exact opposite. Really a mean reversion for the ages. Berkshire Hathaway's gained almost 70% over the past 3 years. ARK Innovation ETF is down 66%. This is interesting on a number of respects. Most interesting to me is that while the overall market, the S&P 500, has definitely recovered, we can see that the most speculative area of the market, the highest growth sector, definitely hasn't recovered, still down a ways from its all-time high. So you could read that in many different respects. And I think it comes back to what we talked about last week, which is the average stock. If you're looking at small caps or equal weight, it's just not keeping up with the major indices. Berkshire, obviously, not holding a lot of small caps in the biggest names. Its biggest holding being Apple, has many of the financial stocks, big financial stocks that have done well of late as well. And we're just seeing this reversion to the mean in terms of quality outperforming over the past 3 years, and really what was outperforming in the 3 years prior, that really speculative area of the market, had that huge bear market and still has recovered a little bit, but not nearly as much as the broad indices. So what about that recession that some people are still talking about? Well, if we look at the luxury goods sector, I would say clearly doesn't seem to be recession signs. We talked about this early last year, kind of saying it doesn't make sense that the economy is in a recession if we're seeing things like Ferrari and Louis Vuitton, these other stocks hitting all-time highs. And we're seeing just similar strength today. And consumer confidence is going up. And this is the latest reading from the Conference Board. We have the highest level of consumer confidence since December 2021. And consumers seem to be spending still on luxury goods. Ferrari had its best year ever, increased revenues 17% year over year. And if we look at their net income, net profits, 1.36 billion, that was a record for Ferrari as well. So it's a huge demand. We talked about this last year. Throughout the year, they were selling out very quickly, selling out years in advance. There's a limited supply, I get that, but just the prices of these vehicles obviously enormous, and they were selling out very, very quickly. It didn't seem to be a situation where that typically you see in a recession, a pullback in these areas. We definitely didn't see that last year, and so far this year, not seeing it as well. Ferrari, very interesting since its IPO in October 2015, massive outperformance in terms of Ferrari versus the S&P 500. Ferrari up 655%, S&P up 180%. If you look at the MSCI Italy index, of which Ferrari is a member, up only 48%. So just massive outperformance from Ferrari. And a lot of that is fundamentally driven. So higher revenues, higher earnings. But we've also seen, very interestingly, a huge expansion in terms of investor expectations, in terms of the multiple that people are paying for a level of sales. And this is really fascinating to me that when I pulled this up, Ferrari now trading at over 11 times sales. Very rare to see that for a car company, especially a car company this established. That's now much higher than where Tesla's trading. You can see Tesla here, the dark blue line. It peaked at a price to sales ratio of around 30 a few years ago. Now it's come all the way down to around 6.8. Yeah, Ferrari now 11.4. So expectations for Ferrari very, very high for an automaker in terms of seeing this multiple of sales. You don't rarely see something like that. So it seems to be investors are saying you're going to see a continued boom higher in sales, or you can start to make the case that, similar to Tesla from a few years ago, but certainly not at the same extreme, that perhaps investors are becoming too optimistic in terms of their expectations for future growth. Talking about luxury goods, the Super Bowl today is definitely become a luxury good. Look at this, $9,800 is now the average price of a ticket for the Super Bowl. That's a record, and there's nothing even close to it. It's actually 70% higher than the average price that we saw last year, and 40% higher than the peak average price we saw in 2021. So huge demand. Obviously, there's a lot of interest because you have 49ers. So a lot of people from California interested. You have the fact that it's in Vegas. You have the Kansas City Chiefs and Mahomes and Kelsey and obviously Taylor Swift surrounding that as well. But just fascinating to see this price so much higher than the prior record, so much higher than last year, and people paying it. So to me, that's another sign. Economy doesn't appear to be in a recession. Would I ever pay this much? No, definitely not. It's crazy. I'm very happy to be watching this at home. You're talking about for a family of four spending close to $40,000 just on the ticket. That seems absolutely insane to me. For most people, that's a down payment on a house. So just absolutely insane, mind-boggling, these numbers. But I guess it's the most watched event in the world, and you're going to have a supply demand situation where there's only a limited number of seats, and I suppose there's enough people willing and able to pay that amount, and that's the market price for this event. And we'll see, perhaps years from now we'll look back and say that was crazy, that was insane. Maybe we won't see a level this high for years to come, but just absolutely stunning to see the price of a ticket this high. So let's talk about residential real estate versus commercial real estate. Really an interesting divide here, interesting divergence where residential real estate prices, as we talk about, are still continuing to go up, which is kind of a crazy situation because affordability is so low. Meanwhile, you're having commercial real estate prices overall moving lower. And let's first touch on residential here. We got another number out of Case-Shiller. This is for November, so it's lagging a little bit, but another all-time high in terms of U.S. residential home prices. And we still have housing affordability near record lows. And we won't dig into it again because I've touched on it many, many times. Big reason driving this is the fact that supply inventories are so low. And while demand has collapsed, supply has collapsed even more. That's leading prices to go up. So up about 5% over the last year. We look at this 20 city index, and now pretty much everywhere, with the exception of Portland, we're now seeing higher prices on a year-over-year basis. Not the same as what we saw during the pandemic or 2021. We just saw unbelievable, ridiculous year-over-year numbers, but much stronger than I would have anticipated and most people would have anticipated, given that lack of affordability, seeing these year-over-year increases and a good number of these markets hitting all-time highs here. It's not just one city. It's many different cities hitting record highs, and the ones that aren't are not that far off in terms of a drawdown. So will be interesting to see what happens with the real estate market this year. As we talked about, if mortgage rates do continue to go lower, maybe we're going to see the opposite situation where supply starts to come on the market and perhaps prices level off and maybe even go down a little. I think that would be kind of surprising to a lot of people. Maybe it shouldn't be after what we saw last year. Regardless, I think 5 years from now, if you're looking at home prices versus inflation, we're going to see eventually a reversion to the mean lower in terms of home prices not keeping pace with inflation, just because it's become so unaffordable. And once supply comes back to the market, you're going to see that prices, maybe not nominally, but on a real level, start to move lower. So let's switch gears and talk about commercial side here. Very different story. We're not seeing prices hit record highs. In most segments, we've seen declines over the last year. Offices being the biggest declines, down over 20% in the past year, but apartment prices as well. Self-storage properties down double digits, industrial down a little bit, and mall was actually up a little bit over the last year. Overall, commercial real estate values going down pretty hard last year. And the expectation is definitely for the office sector, we're going to see that continue. So big difference in terms of the impact of interest rates on the commercial market, a much bigger impact. Obviously, the office situation still being hit by that transition to hybrid and work from home. That's going to take many years, I think, to work out. And the big question for this in terms of the impact on markets is what is going to be the impact on smaller banks. And this was a big issue for a few months last year, and then investors kind of forgot about it. And this week, investors starting to talk about it again because we had that regional bank ETF start to move lower in a big way again. And here's the numbers here. Why is commercial real estate important to these banks? Well, for smaller banks, it's 28.7% of assets. If you're looking at the bigger lenders, only 6.5%. So clearly, big part of the loan book at the smaller banks, and they're likely to see an increase in impairments as these loans come due. And especially office properties, as we've talked about, they're simply not able to pay them off. They're not able to refinance. Many of them have to sell them at much lower prices, and that's going to lead to losses, increase in losses at these banks. And if we look at the divide here, that's being priced in for sure. We got the S&P 500 at an all-time high, and the regional bank ETF here still 35% below its high. So clearly not an impediment to the overall market. We look at big tech, they don't seem to care one bit about this. But in terms of this sector, in terms of regional banks, still an issue, still an overhang for the market. And the question is, does it rise to the level where there's contagion and those fears start to accelerate again? Do we see another Silicon Valley Bank situation at some point this year? Now, remember, that was last March. The Fed put in all of those emergency measures, and those are supposed to be rolling off as we approach March in terms of new lending for these banks. And remains to be seen. I think if there's another crisis like that, they'll put it right back in. So I wouldn't read too much into it rolling off. But I think a lot of people are just saying this is kind of a situation here that's going to take many, many years to work out, and especially in terms of the office market. And perhaps we haven't seen yet the full impact on these banks and on the sector as a whole. So I want to talk about India versus China. We've been talking about China, huge declines in the stock market there, and the big divergence with the US. But I wanted to point out there's also a big divergence within emerging markets between India and China here. This is the last 3 years. MSCI India ETF up 31%, while the MSCI China ETF is down 57%. So just an enormous, enormous spread. We've talked about the problems with China, but why are people so optimistic with India? A number of factors driving that. They're expecting GDP growth, maybe 8% this year. They're looking at manufacturing. India is on the upswing, while China is on the downswing. If you look at 500 executive level U.S. managers here were polled, 61% of them said they would pick India over China if they can manufacture the same materials. So we discussed this last year. We're seeing an increasing trend of manufacturing in India. Apple manufacturing the iPhone. They're building more and more capabilities and factories in India, and talking about doing a much higher percentage in India this year than in the years past. And Apple's just one company. We're seeing many other companies talking about something similar. Meanwhile, China, still real estate becoming a bigger and bigger issue here. We have Evergrande, the biggest property development developer in China, ordered to liquidate this past week. And many people are saying that this we haven't seen the low in terms of the property market. There are going to be other Evergrandes before this cycle is finished. And if we just look at the indicators, and this is data coming out of China, which take it for a grain with a grain of salt, whatever it is, it's probably much worse than what they're reporting. If we're looking at residential floor space sold or real estate investment, anything new starts in terms of homes there, just big declines on a year-over-year basis. And prices, they've come down in terms of what they've reported, but they're probably down much more than that as well. So this is a big factor for the Chinese economy, much bigger percentage of their economy is housing, much bigger than the U.S. And this seems like it's going to take years to recover. The big question being, how much support is China going to give it? How much stimulus are they going to do? I expect if this continues throughout the year, you're going to see more and more things that China is trying to do to prop this situation up. I don't think they're just going to sit there while this situation gets worse and worse. So we'll see if that's effective or not. You could debate perhaps they should let it reprice and shouldn't throw good money after bad, which they were doing for years in propping up banks. But this is an issue that the market is saying we're not done yet. Now, historically, if you look at the U.S., look at Lehman Brothers, when you have these type of big events, you have these big defaults and liquidations, you're usually closer to a bottom than a top. So some might view this as perhaps a good sign. Maybe the situation in China is getting about as worse as it can be. Remains to be seen. We're only going to know that in hindsight. Of course, Lehman Brothers wasn't the ultimate low. The stock market didn't bottom until March 2009. So months after Lehman Brothers, but kind of like sentiment-wise, that was a big signal. And so some people are saying Evergrande is something similar. So I want to talk about the weight loss drug boom. Touched on this a little bit in 2023, but really the enthusiasm has continued this year. Eli Lilly, this is kind of an incredible stat here. It's now past Tesla in terms of market cap, 627 billion this week, passing Tesla, which is around 600 billion, to become the 8th largest company now in the S&P 500. So just a stunning move higher for Eli Lilly. Just to give you some idea, less than 5 years ago, Eli Lilly had a market cap of 100 billion. So you're talking about 6x, less than 5 years, and higher market cap than Tesla. Kind of stunning. Obviously, Tesla is a little bit on the downswing. Tesla was over $1 trillion at one point, now sitting at 600 billion. And what's driving that? Well, a big portion of that for Eli Lilly is about the expectations for their weight loss drug, Zepbound. And what people are saying is it's going to be a big increase in terms of sales in coming years, 3.79 billion for 2024, up to 11 billion in 2028. And the studies so far, of course, have shown significant reduction in weight loss. More people are using these things. There's obviously side effects. Won't get into that as well, but there seems to be a lot of demand, not just Eli Lilly. We're seeing many other drug companies as well, seeing their stock prices go up because of these weight loss drugs. And you could just see the impact. We don't yet have the Q4 numbers, but Eli Lilly's revenue surging higher over the past year, 37% year over year growth, up to 9.5 billion in the third quarter of last year. Just a huge increase year over year, much higher than you would typically see for a company, and especially a drug company, this high. So let's end, as we always do, with something positive, and that would definitely be, in my mind, more affordable rents. Talked about housing, the low affordability there in terms of buying a home, while renting continues to get better and better. And the reason for that is prices are not going up. They're actually gone down now 6 months in a row. If we're looking at asking rents with data from Apartment List, they're down 1% year over year, but down on a nominal basis 6 months in a row. And if we look at the picture here in terms of the average asking rent in the US, you could see peak here is in 2022, $1,441 today. About a year and a half later here, we're at $1,373. So great news is rents are lower than they were a year and a half ago. And what has happened with wages over that time? Well, wages have gone up. So that means rents are becoming more affordable. The good news is that supply in terms of the renting market, very different than looking at the home purchasing market. So while inventories, if you want to buy a home, are very, very low, if you want to rent an apartment, the inventories have been going up. And what we're seeing here is a continued increase in terms of the vacancy rate, 6.5%. And if we look at supply in terms of apartment buildings, well, there was a lot of construction in recent years, and that's going to come to market now. So the supply situation seems to be very good. And so the expectation is perhaps we won't see continued declines in the price of rents, but perhaps we'll have a slow growth year. And as long as wages are going up more than rents, well, that's making the situation much more affordable. So again, we have that hourly earnings number, huge beat, 4.5%, well above expectations. And if rents are coming down, what you're seeing is a much more affordable situation. So what is the expectation in terms of inflation? Well, we're through January now, we're into February, and Cleveland Fed is sticking kind of to their guns here in their forecast, suggesting that we're going to see CPI below 3% in terms of that January number, and they're predicting actually PCE to be down at 2.2%. So that spread, 4.5% wage growth, 3%, under 3% inflation, or if you're using PCE, 2.2% inflation, that spread, very, very strong. We haven't seen that spread that high in a long time, 1.5% higher in terms of your wages over inflation. That's likely, in my view, to boost consumer confidence. It's likely then to extend in terms of how people are spending their money in the short run. At least you have more money in your pocket because wages are going up more than inflation. So a very good sign for now that wages are going up more than inflation, and that apartment rents at least are not going up over the last year and a half while wages have continued to rise. So we'll end it right there. Thanks everyone for joining me. Have a great weekend, and I'll see you next time on the Weekend Charts.